and good morning to those joining us from the West Coast. Welcome, everyone. Oh, sorry, if you can hear that. My name is Rose Pina on behalf of PCI. Thank you for joining us for today's session, Government, Contract, and Award Terminations Post-DOGE, running from 2 o'clock to 3:30 p.m. Eastern. Before we get started, just a few quick housekeeping notes. Please feel free to drop your questions in the chat at any time. I will be keeping an eye out for those. If you're having any technical issues or any material-related questions for our instructors, I'll be sure to bring that up to them as well. For the materials, you should be, I don't have the slides up here, but you should have been emailed them by Ophelia today, so you could follow along on the PDF slides. If you're here for CPE or CLP credit, make sure to write down the 3 passwords I will be saying out loud during today's session. After we wrap up, just head to the PCI website, log into your account, go to My Certificates and Courses, and select today's training to enter the passwords and complete the survey there. Thank you again for joining us, and with that, I will turn it over to our instructors from BRG, Rob McDonald and Clint Wolfter. Rob, take it away.
Thank you very much, Rose, and hello, everyone. Alongside my colleague Clint Wolfter, I am Rob McDonald, and welcome to the Government Contracts Terminations webinar. For the next hour and a half, we'll be providing what we hope to be a wide-ranging with some depth introduction to some of the important aspects of government contract terminations and assistance awards terminations. So we're pleased that you join us. I want to start by echoing Rose's comment about questions. If you have questions, please don't hesitate to put them in the chat. We are going to try to tackle a couple at the interim breaks, I think about a third of the way through or 30 minutes through each portion of the webinar when Rose gives out the CLE and CPE clues. So I think we work it that way, and then we cover anything at the end if we have time, and then of course we will answer any unanswered questions afterwards, either in an email reply or even a conversation if that's needed. So thanks again for everyone joining. Why don't we begin? I'm going to start by introducing our firm, Berkeley Research Group, or BRG. BRG is it's a global expert consulting firm with over 35 offices. Every major continent in the world. We have approximately 1,500 billing consulting professionals, and so it's a really a great firm. I've been here about 8 years now, but the services BRG provides are expert services around disputes and investigations is one large category. Another one is corporate finance, provide transaction advisory services and restructuring services around bankruptcies, et cetera. And then performance improvement is another major category of services BRG offers. Clint and I mainly inhabit the disputes and investigations, but we provide a wide range of compliance services, and we're going to introduce our practice next. Clint and I are government contract specialists. We're experts in government contracts, and our government contract in grants advisory practices. By the way, you see our photos and our contact info here. I just make special note of either or both of our emails on the slide. So maybe you jot those down and feel free to email us if you have any follow-on questions, but that's how you get a hold of us, best way to do it. Our practice is around a broad functional set of government contract related issues. We are procurement specialists. We handle quantitative aspects of claim and request for equitable adjustments, preparation. We do termination preparation quite a bit in 2025, I can tell you that. We do a wide range of cost accounting and government contract accounting and other forms of government contract compliance work for our clients. We do a lot of fraud related investigative assistance, working often under the cloak or the umbrella of privilege and confidential with along with our teammates, external counsel on certain kinds of investigative matters. And lastly, we do a lot of strategic advisory work with companies that are either new to government contracting space or interested in growing their government contracting business, and helping them build the proper infrastructure and processes and systems, placing them in place so that they can execute on a compliant manner and successfully grow their GovCon business. So that's a little bit about our practice. I also want to just, before we start, we're going to cover the agenda next, but I want to sound an empathetic note to everyone vis-a-vis terminations. This has been certainly a very eventful and traumatic year for many business owners or government contractors, assistance awardees, et cetera, dealing with, in many cases, wholesale terminations of contracts and grants. And it's been difficult. And I know many of you, are working very, very hard, harder than you ever have, perhaps. And we've heard a lot of war stories. We're hoping to, share some anecdotes from what we are seeing with our client work in 2025 and really help you get a grasp of the right steps to take in a pretty complicated environment. So with that, just a bit about the agenda. We've got in section 1 here, we're going to cover some high-level news, I guess, on 2025 about terminations, some of the executive orders from back in January, ancient history, that kind of was the nexus or the nascent birth of a lot of these terminations that began to come out early February. We're going to cover terminations defined very basically in section 2. I will say this presentation focuses on terminations for convenience, which are by far the most common forms of terminations we've seen thus far, and also the most complicated in terms of quantification and even the legal and managerial aspects of what we're facing. We'll talk about some of the exact recommended steps once a termination notice is received. We'll talk about we'll take a deeper dive in section 4, talk about various contract types, how that impacts how you structure your termination settlement proposal, the forms you use, the approach you take, the kinds of costs you include, the kinds of costs you don't include, how you include them. We'll touch on a lot of that. I think you've got the deck already, most of you. We'll also talk about what I like to call the close cousin of termination settlement proposals, requests for equitable adjustments, which is requests for monies to cover out-of-scope changes to work, and stop work orders that have very frequently accompanied the terminations or have stood alone as a common occurrence in 2025. Then we'll wrap it up some takeaways and have a reference section for your viewing pleasure post-webinar. With that, that's a lot. That's a little bit of the agenda. And I need to stop for a minute. Talk about
how did we get here? Well, the new administration, there were, as Rob mentioned, a flurry of executive orders that occurred back in January, and you really had to almost read the website daily, hourly, to see what was going on. We've put the top 4 that impact this session, with the regulatory freeze of spending, the implementation and creation of the Department of Government Efficiency, and then starting the ending of radical wasteful government DEI programs and preferencing executive order.
I say that's the EO's language, not ours.
They can't hear me. I'll turn on the audio.
If everyone can mute, just, thanks.
And then finally, they have the council to assess the Federal Emergency Management Agency. So there's a big FEMA review that happened as well. So with those, there's been like 160 executive orders that a range of subjects as everybody's watched the news. When it first came out, everybody was watching USAID and what was going on there, because they were basically the leadoff batter, so to speak, with the terminations. Since then, there's been a host of other agencies that have been involved. This is from the DOGE website, noting I guess the people who are leading the way and people who are at the bottom of the way with the least number of savings and most savings. But this is across the board, not just terminations, but everything from maybe facility closures, cancellation of leases, improper payments, you name it. If DOGE found it and they thought it was not in accordance with what their referendum is, it got put on this list. And so they've calculated who's got the most savings and less savings, and you can read that for how you want or spin it how you want.
Yeah, if I could add, if you go to their site, I don't know if everyone's been there, they have this top 10, bottom 10. And by the way, these are their words again, most savings. They're really just a ranking on the left of the highest cuts in terminations to based on agency by agency. Yeah, everything, include cuts that would be in terminations and layoffs, etc. But there's a spreadsheet right beneath this table on that website that has a lot more detail. Should you be so interested in performing more detailed research?
Yep. But what I have found, Deltec has also been keeping a good tab, and their tab is what they publish is in more detail than what's on the DOGE website, I believe. And from what we just pulled as of the 12th, that's what they dated it. All this is a list of all the contracts terminated for convenience. So and this is at the contract value level. And from here, everybody was talking about USAID in the beginning. Well, the DOD is really kind of, I don't want to come in first place, if you want to call it, if that's something you want to be in.
Which may surprise some people to see that big dark blue piece of high there. That surprised me, frankly.
Yes, that and HHS is high up there too. And so I was also surprised, Rob, with Homeland Security, thinking there was a big push with Homeland Security spending, but yet they've had 19 billion of terminations. And you can drill down into the contracts and things of that nature as you get down into the details for whatever reason. But this kind of gives you a good idea that it's not just within USAID, it's not just within Health and Human Services. Defense is a big piece, and then the other agencies. There's like 50 plus other agencies out there that are getting the unfortunate news of being terminated. So with that,
yeah. So
what happens?
Well, if you think about that pie for a sec, my impression is these terminations are in a few instances, there are entire departments or agencies that have been targeted for wholesale termination. USAID, there's been a lot of talk about Department of Education, large parts of HHS. But another aspect of the terminations is more functional. You mentioned that DEI executive order that cuts across all the agencies. So that's why you're seeing agencies, departments like DOD and HHS, or sorry, DHS, so heavily impacted. So what do? You got a little bit of information. You need to be looking at all of your government contract awards, not just the ones that have been terminated, and understand and develop a view, a near-term forecast, if you will, of and take some proactive risk management steps based on what you know now, what's been terminated, what your government contract or assistance award portfolio looks like. Here we are in almost halfway through the year, and we've seen more twists and turns in this month about where the next termination, the next client that contacts us. It's very hard to predict. Even though the DOGE may have receded a bit in the news cycle, there's still,
It's still happening.
It's still happening, and it's can happen to, even unsuspecting government contractors. So it's important to look for ways to prudently manage your business, conserve cash where it makes sense. Obviously, continue to perform on existing contracts and assistance awards, but also evaluate your overall business continuity. Understand, perform scenario planning and simulations, if you will, in terms of what would happen to your business if another, portion of your government business were terminated. And if you haven't terminated already, you understand the effort it takes to submit proposals, et cetera. So things like delaying planned capital outlays, capital investments, just a slightly more conservative management of your business is recommended in many cases. Depends on your size, your circumstances, a lot of factors, but these are things to keep doing.
No, definitely. I think one other thing here, not on here is, you know, maybe as you get contracts terminated, look for other opportunities to get funding somewhere else. So the source of funding could be, I've talked to a few clients where they're now going to the States. Right. Or I got one client that is actually, we're developing rates for that it's going to the UK to look at some grants and awards coming out of the UK for the same type of work that just got terminated here, but they can do it over there, or even go to the source wherever the contract's being performed. Maybe that home country would do it too.
Yeah. So yeah, looking on the kind of, I talked about the cost side, but
Yeah.
look for opportunities.
There's
Right,
opportunities.
the revenue side.
Yeah.
Where can you take advantage of the circumstances today? So anyway, so let's just define very basically a contract termination. What it does is it ends each party's, there's the two-party counterparty, your buyer, your customer, if you will, your government buyer. It ends both parties' obligations under the contract. There are termination clauses that are very unique to government contracts and assistance awards. And attorneys and non-attorneys alike should be familiar with those termination clauses. There are a whole host of different types of termination clauses. So understand which ones pertain, which ones in your contract or award. I mentioned earlier, the overwhelming majority of our discussion today will be about terminations for convenience. That's a very unique GovCon specific type of termination. Where essentially the government is exercising its unique right to completely or partially terminate the contract entirely of its own convenience. The nice part about T4Cs is that given that unique right the buyer holds, you as the service provider, the manufacturer have the right to be made whole. And that's what the regulations allow for. There's a lot of complexity surrounding what needs to be collected and submitted as a termination settlement proposal, but that's a unique right, and it's worth your effort to engage in collection of the cost data around a termination. You also have terminations for default. That's very much akin to termination for cause. Termination for default, in my view, is essentially the government contracts version of a termination for cause, where you're terminated because you failed to perform. That's a very, very bad circumstance to be in. It should be avoided at all costs. And there's some steps you might be able to take there that we'll talk a little bit about it. Termination for cause, same thing as T4D, except FAR Part 12, the federal acquisition regulation, and we'll talk about it a good portion today, is the procurement regulatory encyclopedia for federal procurement. FAR Part 12 deals with commercial commercial item contracts or commercial products and services. So just, you want to lump T4D and termination for cause together there. Partial termination, as you might imagine, is when part of a contract or part of the performance work statement, et cetera, was terminated, but the rest of it, the government wishes or wants that to continue performance. We're also seeing a lot where you have sort of short-term, let's say 1-year term period of performance, and the government's just choosing to simply not exercise subsequent options. That's a little more limiting, but it's something to be aware of and plan for. I talked about the federal acquisition regulation. Well, it is it's a thick set of procurement regulations. It's been around for, at least close to 60 years as in that namesake. There's some particular parts of it. It's arranged in various parts, and it's got a very complex structure to it. But FAR Part 49 deals with the termination of contracts and deals with general regulatory rules vis-a-vis terminations. FAR Part 31, contract cost principles and procedures that deal with the allowability of costs incurred in the performance of government contracts and assistance awards. That's an area where, in general, Clint and I spent a lot of time and it's often a tough and unique compliance area, very accounting oriented for, it's something that's unaccustomed to a lot of commercial folks. So something to be aware of. FAR Part 12, especially subpart 403, it deals with termination. Those are with, I mentioned before, basically the government contracts version of a commercial contract. They're trying to like mimic a commercial contract when they're buying things like paper clips and office furniture and indistinct items. That's what they tend to use. Yeah, so there's relevant procurement regs to each of those. For T for C, it depends on the type of contract. You've got firm fixed price, you've got cost reimbursable type contracts. The rules around cost recovery for terminations vary depending on those types. Likewise, there are terminations for grants and cooperative agreements or assistance awards. Those tend to more closely align with the T for Cs for cost types. Uniquely, assistance awards, grants, and cooperative agreements, COAGs, follow a different set of regulations, uniform guidance. They're not followed by the FAR. They're not governed by the FAR. We'll touch on that a little bit and deal with that. Okay, so here's the thing. Here's the good news. Contractors and assistance awardees are entitled to be compensated for all costs associated with the closeout of and termination of a contractor award. You're entitled to be made whole. That's easier said than done. It involves this process of developing a termination settlement proposal, engaging in new business negotiations. It's a contract administration function. It's not a dispute-based or not meant to be an adversarial relationship. After all, the government is terminated for their own convenience through no fault of the contractor. You're just sitting there and you get terminated. It is very important, however, to bring on outside government contract legal counsel. And often in most cases, we're doing a lot more work than the attorneys are because the work, the nature of the work is cost accumulation and reporting and tabulation, and there's a lot of indirect rate impacts, that sort of thing. It's important to bring on outside expertise. Because it's a very nuanced area that, and you've got your day job you've got to worry about, and we can help. B, the regs permit recovery of settlement expenses that include external costs like accounting and cost recovery help from people like Clint and me, as well as from counsel. FAR 49, here's I thought was an important phrase. Everyone should keep in mind, the settlement should compensate the contractor fairly for the work done and preparations made for terminating portions of the contract. And here's the other thing I mentioned: you get a reasonable profit on all these costs. So it's not just recovery costs; you get your profit. We'll get into how that's calculated, what that is. And importantly, fair compensation is a matter of judgment. It cannot be measured exactly. So it's not, I mean, it's a business negotiation, and things like estimates can be used, and a compromise process can take place. This is not, a exact figure that you're seeking in a court of law. But something like that, at least not yet. Anyway, you submit TSPs to recover these amounts, and you need to come to an agreement with your buyer on that amount.
Right. It's the government wants to make everybody whole. Not something you find in the commercial world. It's very opposite what the commercial world would be. But the government just wants to make the company whole.
Yeah. Yeah. You just don't see, I mean, you would typically sue your buyer
Right.
in a commercial world if they just backed out of the contract. That's normally the, so, here's some other real just important language to kind of keep in mind. This is all kind of table setting and understanding, what are your, what do the rules say you can do? What is your, how do you begin to think about putting your costs together? Entitled fair compensation. Look, the government wants to reach a fair agreement. And it doesn't have to take one set strict form. There are some requirements on the forms you use and that sort of thing, but particularly once the negotiation begins, the negotiations can go in a myriad of different ways. Also, this is not all the data in termination settlement proposal needs to come from your audited financial statements. In fact, very often, very little of it does, because the data is it's either too current, too recent. It's either, it's accrued costs that have come out of your general ledger that you're pulling from your ERP system, or I talked before, you're using estimates. A lot of you're not allowed to seek anticipatory profits like forward-looking. However, there's a lot, and we'll get into this, there's a lot of contract commitments that you as a service provider have made as a part of helping you perform that contract that's going to be recoverable. And that recovery is going to involve estimates because it's forward-looking. You make prepaids, all sorts of deferrals, and accruals can be brought to bear in an otherwise firms might not think about.
Right.
But you really can think more broadly here in terms of cost recovery. Again, record keeping, reporting, accounting related to settlement needs to be kept to a minimum. Again, you have day jobs. Their main mission here, of course, is to protect the public interest, the public purse, and not to spend too much money with you. So that's their motivation for driving a bargain.
All right, so we'll touch a little bit on terminations for default, or T for D. Those are not good things to receive. Typically, if you've gotten a T for D, you've been expecting the T for D. It should not come as a surprise. You have to go through a lot of corrective action requests that have come down to the government, all the way up through probably a cure notice that's been delivered. And so if you go through all the 3 levels of a car, and then you get to level 4 and a cure notice, and you're still not doing anything, more than likely you'll get the termination for default. It's detrimental to the company to get this. I think once received, you should definitely contact your either internal counsel and or external counsel, excuse me, to start mitigating everything you can. Because you get these, and it makes it hard for going forward in the business to bid new work, because you've got this T for D hanging out there that can be judged against you. And the largest T for D that's on record right now, it's a world record, so to speak. It dates back a few years with McDonnell Douglas and General Dynamics, where they tried to build the A-12 Avenger plane, and that was apparently a disaster. They couldn't even get it off the ground. There was a lot of cost overruns and performance issues, and it was in today's dollar, about a $10 billion T for D.
That was the 1990s, right?
Yeah, it was a while ago. So anyways, it could be, that's just a little static fact to take away. But we're not going to focus on T for Ds. We're back in the T for Cs. So what's the difference between a T for C and a T for D from a financial perspective? The big difference is the recovery of anticipated profit on work that's not yet performed, or on settlement expenses. Whereas the T for D, you're not going to get that. You're just going to get, the government is just going to, basically the T for Ds, you're drawing the line and you're done. The government can get, for a T for D, unfinished raw materials that are still laying out there, that the contractor might still have. The government's entitled reimbursement from the contractor for any extra costs that they might incur to complete whatever you were building or drawing or servicing or whatever it is. So there's an additional loss. Whereas Rob was mentioned earlier with the T for C, you get the fair and reasonable profit on the work performed, recovery of settlement expenses, recovery of work already performed, and any unavoidable costs. Could review, please.
Unreasonable. I flew 8 hours to Germany to try to work things out with you.
Sorry, I can hear someone's.
You get this. Yeah, well, we're 30 minutes in, Rose. Is now a good
Yes,
time
I
to
was about to
provide the
say.
clue?
Yes, perfect. I love that you call it the clue. But yeah, sorry to jump in. For those of you seeking CPE or CLP credit, your first password is water. That's capital WATER, just with the W being capitalized as it is case sensitive. And that's water, WATER. Please be sure to write that down, as passwords, again, are case sensitive on the PCI website, but you're going to log in after today's webinar. And that is the first of 3 passwords I will be announcing today. All right. Sorry about that. Back to you.
Rose, are there any questions so far in the chat?
I do not see any yet. And just in case
Okay.
anyone missed it, you can go ahead and send any questions in the chat. You can raise your hand if you wanted to unmute yourself at some point, but just stay muted for now and you can send whatever in the chat.
Okay. Okay. So T for Cs are not common, as everybody has realized. At least they're very uncommon at this level that's been received so far in 2025. They are major events that will happen within a company. The first thing to do is to make sure you've got a T for C in writing, and then also responding that you have received T for C. That's like number 1 right there. Number 2 is to contact your outside counsel or inside counsel to let them know that's there. And more than likely, with the termination for convenience, you probably received a stop work order, and you need to communicate that out to the appropriate folks to actually stop performing. So that's very some of the things very important to do. We'll get into some other items as well. Navigating this process is going to be very difficult, especially because with the T4C, unfortunately, you might have to lose some employees because you just won't have any work for them. It's sad, but unfortunate. And then on the other hand, at least in today's world, you're losing government people as well. So come September, when the opportunity presents itself to a lot of government employees to take that early retirement, it'll be even harder. So it's important to identify who the appropriate contracting officer or termination contracting officer is going to be responsible to settling the contract. And if you don't know, get help quickly. All right, Rob, we got a piece of paper in.
Yeah, so I've received a contract termination notice. What happens next? So we've done an introduction. Now let's kind of get down to some more micro steps. And when you receive a termination notice, that is the notice that you have been terminated for the convenience of the government. It will be a letter. And it will state the following. It's going to say that the contract is being terminated for the convenience of the government or for default. Hopefully not, but it will point to the contract clause, the 52 clause, authorizing the termination. That's an important clause. It'll state the date effective of the termination. It'll discuss the extent of the termination. I mentioned a partial or complete. And it is really important to pay attention to that. It'll provide special instructions. Those are often common. And usually these are 1-pagers, sometimes they're 2. These special instructions run long. And often this year, particularly, there's stop work on relevant portions. And the stop work notice is essentially it's not a termination notice, but it's very similar to termination notice. And the stop work notice will sometimes refer to the possibility of termination upon being informed by the government. So that's what the letter says you will have. Next slide.
It's a very short letter.
Yes, usually. So here's a little bit busier slide, but these are important steps to take when you get the notice. Okay, and this has to do with if you're a prime contractor or you have a subrecipient on assistance award, one of the very first things you need to do is identify your subcontractor, your subawardee, and flow down the termination to those subawardees or subcontractors. You need to, usually the termination notice will tell you to do this, and it's important to do it immediately. That's an urgent step. Understand kind of where you stand on a partial termination and make clear, if there's a requisite partial subcontract termination, how you kind of manage that, but you need to keep them aligned as best you can, the prime and the subcontract. Obviously, no new subcontracts. And of course, you need to stop work on relevant portions of the contract identified in termination notice. And it's more than stop work, it's terminate work. So it's things like identifying and developing a list of closeout activities that need to happen to properly close things out. Now, this might be if you're a services provider or a consulting firm, most of your costs are labor costs. That's one thing. If you're a manufacturer, you have delivery orders, and you have a manufacturing process in place that's been terminated, that is another thing. And that could be rather complicated. It's just take stock of what does it mean to stop and terminate work? What steps need to take place to break down equipment and disassemble teams, et cetera. For manufacturers, that third column from left, process inventory records, disposition of WIP, work in process products. This sort of thing should be, you really need to do your very best to understand what the government's telling you and conform to those instructions. We'll give you some additional insight in a couple slides, but these are the first steps. Protect property, costs protection, storage of valuables, et cetera. And lastly, on the right, this is as important as anything, document your conduct and costs. So as accountants, we tell people often to establish unique charge codes for termination, both at the direct level and even at the indirect level, and especially at the indirect level, to begin to track the time and effort expended by direct labor and indirect labor on the termination. You can employ, understand the time spent using payroll records, understand your cost to supply the services you're providing, and more indirect costs, legal, consultant, et cetera. Document your costs, both from a numerical standpoint and an entitlement or description standpoint. Next slide.
Yeah, but I think Rob, for the next one, I think the two middle boxes there's a couple of things that I don't know if it was caught, but when you get that stop work order, it's important. Yeah, you put your pencils down, so to speak. But if you're in the middle of pulling something together, you can have an opportunity if you have a good relationship with the contracting officer or the TCO to say, hey, look, we're in the middle of producing X, Y, and Z. How about we stop when we have it produced versus just kind of in the middle of, you get like a half thing, a half a product or a half a pencil or I don't know, like a half a sandwich or something like that. Why not get the whole one? You already got it, or half an airplane. Likewise, with the inventory records, just get clear communication with the CO on who owns what inventory at the end of the day here. So it's something you have to figure out. I think we get into it later.
Yeah, we get into it later, and that's very important. Having a good relationship, the better your relationship with your CO, the more smoothly things will go. And you should, open lines of communication. There's been some issues where many COs have rolled off, or they've been laid off, or they've taken the fork in the road. It's hard to, in some cases, it's hard to find someone to talk to. Believe it or not, it's pretty, amazing. But that's the world we live in. For cases where you have a relationship, I would do your best to meet the deadlines. Like, for example, sometimes they'll want to defund or deobligate a portion on the funding side as an initial estimate of what is involved with what money is going to be required to be cover the termination costs. Meet those deadlines, but defend your position. Do not be conservative with the amount of money you estimate as an initial. I mean, this is where you really have to think about everything you're entitled to. And in 9 out of 10 times, the clients I've talked to, they think they're entitled to a lot less money than they actually are. Mm-hmm. So, you really want to defend, buy time where you can. But at the same time, if they've been giving you and normally there are regulatory deadlines for TSPs, like 1 week, 1 year after the termination notice. Now that's really unrealistic. now, often they'll tell you, they give you a few number of weeks, et cetera. But it is important to begin work on this stuff immediately and to get organized, get the charge number set up, to understand who does what, to involve multifunctional teams. We've got a slide on that.
And I think it's important, Ron, with working with the contracting officer about the funding. I mean, yes, you have technically 1 year to submit this, but the agencies are under a lot of pressure to save money and move money around. So they're wanting to see if you've got, I'm gonna just make it up, $5 million left on this contract. They're going to want to try to take as much as they can out to put it somewhere else, because they can show them, they're showing, oh, we're saving here. I've taken 5 million out and it's going over here. So they're trying to move money around, and you want to get your money back.
Yeah.
Without them taking it away.
Yeah, if you think of like a square, two continuums, like speeds, fast, slow, and then lots of money, little money. I say go fast and ask for a lot of money.
Yes. You go fast, that's for a lot of money.
And it's got to be all supported, but one, it's a debatable.
You're not gonna go up.
Right.
It's gonna go down.
It's also the beginning of negotiation. So that's why you want to start high if you're going down. Okay, so this maybe show just the title slide there. Implications of various contract types. Now we're going to talk about some of the specific contract types and some of a little bit more of the nitty gritty. We're not going to get too much in this, this webinar, but time permitting. This is all about termination for convenience. And I mentioned earlier that the government has a commercial proxy procurement method, FAR Part 12. Many contracts, however, and I'm not talking about assistance awards here. This is about procurement. Non-commercial side, FAR Part 15, contracting by negotiation. Though that's the more common and more complicated contract to deal with in termination scenario. Inside FAR 15, you've got both fixed price and cost type and time and materials type contracts. On the left side, you see on the commercial side, FAR 12 subpart 403, paragraph 4 governs the calculation method in standard. There is no standard form. The sort of calculation language for recovery on a FAR Part 12 contract. It's price driven. It's basically a percent complete type calculation that's done on the left. On the right, fixed price, you have two options. FAR Part 15, fixed price, you can do a total cost basis, you use standard form 1436, or an inventory basis 1435. Total cost basis is although the dollars are larger, it's often a simpler way, a simpler calculation, and certainly for services providers, for consulting firms where direct labor dominates the cost structure, those are often easier. However, if they've been running, multi-years, the numbers can run high. You're calculating basically the total cost of all costs incurred during performance and through termination, and you're subtracting the amount of you're subtracting the amount of work that you've invoiced and been paid for from that. That result is what you're owed. Inventory basis, on the other hand, is specific to the termination costs. It's specific. It doesn't have to be used exclusively in products and manufacturing. It is clearly most often used in that way, but it can be used for services. But it's more specific to the actual termination costs, a little bit more like that cost reimbursable standard form 1437 over on the cost type, that is unique to the termination cost. So I think this hopefully this decision tree gives you a sense of what direction you need to go in there. All right, so differences T4C. Okay, we talked about that FAR 15 fixed price contract. With fixed price contract, you're paid only for work, paid for the work completed up to the termination date, as well as costs directly related to the termination date. So obviously, you don't stop on a dime incurring costs. You continue to incur costs related to the closeout of the activity, number one, and separately, the development of the settlement proposal. Both internal expenses and external expenses like ourselves, both direct, both indirect, all that comes into play. With a cost reimbursable contract, that kind of looks more like a final voucher or final invoice. It's a little more typical of the invoicing process that was in place already. You're essentially entitled to to be reimbursed for all allowable costs incurred up to the termination date, including some costs related to a wind down. So it's similar to a fixed price, but the language is different, and there are a few important nuances. There are also similarities. I'd say, let's see, yeah. Essentially, what happens with the fixed price is it gets turned into a cost-based or cost reimbursable type scenario because the costs that you incur are driving the recoveries on a termination of the fixed price contract. That's been the case all along with the cost reimbursable contract. Both of them sort of, de facto convert to a cost reimbursable type contract directly stemming from the termination.
Okay. So we have terminations of fixed price contracts, and you can refresh yourself back to that decision tree matrix. If you, and also think of yourselves, am I a services company or am I a manufacturing company? So if you're a services company, you're going to be focused on the total cost basis. If you have a fixed price services contract, you're going to probably want to do your termination settlement proposal on a total cost basis for all the costs incurred under the contract up to the effective date of the termination. Whereas if you're a manufacturing contractor, you're going to want to use the inventory basis because then you're going to also get into settling units or items or materials as well. So with the inventory basis, that allows you to do that and gives you a good roadmap within the form. As mentioned, the inventory is used always in the manufacturing, not always, but mostly in the manufacturing. And so you keep that in mind. So that's the two big takeaways from this piece here.
There's one thing I forgot to mention. It's a word we need to mention here. The regulations rather expressly state a preference for the inventory based method on fixed price contracts. In fact, they say that you need to get your CO's approval to do total cost basis. We would suggest, certainly if you're a services company, to get that approval and go with the total cost basis in most cases. Circumstances specific, but I wanted to mention.
Yeah.
The Reds have a stated preference.
Which I can never figure out because if you look at the form, it does describe.
Yeah. Yeah, you can actually found the total cost a little bit easier in those cases, but whatever.
Whatever, whoever did that, I don't know how many years ago it was. All right, so settlements using the total cost basis. You got to think of it as, I always think of this as you're putting together your annual provisional billing rate, or not even provisional billing rate, maybe your more annual incurred cost submission or your annual NICRA for the folks in that world over there in USAID world. With the total cost, you're going to have all the costs are going to be there. They're all going to be supported. They're all going to be allocated or allocable and reasonable. And there's going to be evidence behind that. And the key words here are, they're going to be actual costs that you can support. And it's pretty cut and dry. You're putting together the proposal. You've got, names of people behind it. You've got, maybe severance that goes along with them. You've got facilities that are closing. You've got lease termination amounts that you've got. You've got phone bills, or you've got software you get to turn off and you have to pay a fee, whatever that is. Or you've approved something for some costs that have to carry forward for the next year because you're already contractually obligated. So it's pretty easy. It's pretty cut and dry, total cost basis. So when you're preparing this, as I mentioned earlier, you want to make sure that, as I mentioned, the proposal is material, labor, and overhead have been reliably computed. So really, it's the overhead has been reliably computed. That's the indirect rates there. We're getting into that and applying that. You also want to make sure it's acceptable accounting evidence, kind of going along with GAAP. If you approve something, you've got some evidence behind it that shows how you came up with the amount, or you have an actual receipt or something like that because you haven't quite paid it yet. I think another piece here is all the costs that are being claimed are applicable to the contract. So a good example with this would be, let's say you have, you're running a software system that manages productivity. And it's not only for this contract that was terminated, but other ones as well. Well, if this contract goes away, it was technically absorbing some of that software cost for the productivity measurement. So you should be able to come up with an allocation basis and claim part of that software cost, even though you're still using it on other programs. This program was using it and did pay for it.
Right, there's a causal or beneficial relationship there, and
Exactly.
this is the detailed, unique, nuanced kind of example of.
It's exactly.
Entitled to the termination cost principle.
Right, so it gets back into, you just can't throw this proposal together and send it off. You really want to make sure you've got everything recovered. I mean, you want to try to get as much, the goal here is to get as whole as possible.
Right.
Let's see, is there anything else here? No. All right. So we've talked about we've thrown around the 1435, 1436 forms. This is a good slide here that outlines exactly which form goes with which type of proposal. I'm not going to go through and read them all, but the 1435, the 1436, and the 1437, those are the three forms that you should be well aware of. I think most people who are on the cost reimbursable world are going to be using the 1437. I'm not sure. We should have polled the people to see who's in a manufacturing environment. Probably, with our luck, it's probably all manufacturing people on the phone. But nonetheless, and then there's another couple of forms here at the bottom that you got to be aware of that have to go in with the proposal. The schedule of accounting information. So this is a schedule very similar to
Disclosure statement.
a disclosure statement, or it's similar to like a self-assessment of your accounting system. It outlines, what kind of system you use, how you allocate your costs, what's your makeup of your pools and your basis and things of that nature. It does have to go in with every TSP. So keep that in mind. And then the 1438, the short form of the settlement proposal, I haven't seen anybody use that yet.
Yeah, and also the inventory disposal 1428 needs to be used there.
And something else that I don't think we mentioned on this, Rob, but with the TSP and what we've been doing is we also have, the TSP is basically the numbers, the dollars. This is what I need. This is what is being supported. This is what we're asking for reimbursement. But you also need a story to go along with it. And so with that, we like to include a narrative that goes along that explains, okay, yeah, I've got all these severance. These are the people getting the severance. And here's a narrative that goes behind, when they're getting it, why they're getting it. It might be an in-country statutory rule or law that they have to have, and this is why. And this is why we have to keep these attorneys, the in-country attorneys, on the table, because they've got to settle, payroll taxes, et cetera, whatever country they're living in. So it gives having that provides a great story for the contracting officer, for the form when they get it, so they can read and say, yeah, okay, this is a legitimate type of expense that they're trying to seeking reimbursement for.
It's absolutely essential. I mean, it's part of the TSP, and it speaks to, we got the REA slides, it speaks to there's the quantification aspect, there's the entitlement aspect, the why. Why am I entitled to this? All that is going to be explained in words, and someone's going to read it.
Exactly.
So it's not just spreadsheets.
All right.
So we're going to talk a little bit more about the narrative and the cost basis, the entitlement. But keeping on the quantification side, we thought we'd do a total cost basis, fixed price, just a simple numerical example. So this would be standard form 1436. This is where you're looking at all costs, total costs, hence the name, incurred over the entire performance. Here we have a simple example where you have 75 indirect labor, 25 direct material. You've got 100 in total direct costs. You apply overhead, you apply G&A costs, and then you apply a profit You then deduct work completed that's been invoiced or to be invoiced on a separate matter. And I would say there is, in 2025, there's a bit of an exception to that. We're counseling clients to submit invoices, as you're going through this process. And it's doesn't necessarily need to be a deduction there, as long as in the proposal, you have clearly noted that this specific amount has been invoiced but not yet collected. And if it were to be paid through the invoicing process, it would be deducted from the TSP. Remember, it's a business negotiation. So you're having conversations with the CO about this. Then absent profit, you add settlement expenses and settlement with subcontracts. You get to a gross settlement, and then any kind of advance payments get deducted to reach your net settlement requested as part of your proposal. Hopefully that's just a real simple example of kind of the structure you need to walk through numerically. All right, so what get recovered? Let's get a little bit more specific. You get indirect, you talked about rates and, what are indirect rates? People don't know, aren't accounts. I don't know what they are. You have overhead costs or indirect costs that are not associated with the single final cost objective, which is usually the contract, but instead are associated with multiple final cost objectives. Same with G&A, that's at an even higher level, a headquarters level. So talked about, and this is again getting into some complexity. When you turn on this termination mode, post termination notice, it's best practice in our view to, and even at the indirect level, people that are typically indirect set up that direct charge codes, charge them as direct costs, and seek them as a direct cost of the termination. And there's some important caveats with that. There's some reclassification of costs on the indirect side that need to happen, but you're entitled to those costs. You're entitled to personnel, product costs, labor, materials. You're entitled to rent, facilities, any kind of lease obligations, the facility cost of capital, unexpired leases, and any kind of contractual commitments related to facilities that you are unable to recover needs to be borne by this contract. Therefore, that should be part of the TSP. You're entitled to it. Talked about termination settlement costs. Not only is that external people that eat the hard costs, people like BRG and the attorneys you're involving, but also senior people, management, their time, their effort. They go back to that, set up the charge code that's indirect and start charging, so that those meetings and time, et cetera, can be captured and charged to the termination.
No, absolutely. I think you covered it all. The only thing I can think of is like, if you have to have a storage facility to bring all your stuff back to store. That storage facility to house the equipment or whatever was in your office at the time that you got to vacate, that's recoverable.
Yep.
All right. So the government's going to come back and you submitted your proposal, and according to the regulations, if it's over $2 million, it's a required audit. By the government.
That is by the way, that is mainly essentially a cost of pricing data. It's basically a truthful cost of pricing data act requirement, right? So I just take a moment. I think we're on schedule here.
Yeah. Oh yeah.
I just, what that is everything you do to price your termination, all of the financial information collection. There are strict rules that are subject to the Truthful Cost of Pricing Data Act that essentially require that everything's fresh, everything's current, that the government has an equal footing or position with which it can negotiate with you. And in order to understand, otherwise all of the power and negotiations would be sitting here with the contractor. If you don't know your costs, so you have to prove to the government these are your current costs, are current, accurate, and complete. That's the phrase in the law: current, accurate, and complete. So that's what that is. point out.
No, very good. So, and then the government's gonna come back and ask for some supporting data. They're gonna ask for, the price proposal at the beginning, what's the contract say? They're gonna look at your, potential, your cost estimates. They're gonna look at support behind that. And they might look at shipping documents. They might want to see purchase orders, things of that nature, things that you probably would have supported during an incurred cost submission if you have cost type work. It shouldn't be anything new or unusual. What part that's unusual here is it's the government's, as Rob just explained, everything over $2 million is supposed to be audited. Well, last I heard, DCA gave an estimate that it would be 2 to 8 years to audit all the proposals over $2 million. Well, as we all know, that's just not acceptable. I mean, companies can't be waiting 8 years to get their money back. They'll be, hope just build.
Well, that's a reason, Clint, that, we talked about this invoicing.
Yeah.
And what we're seeing really near term, I mean, get your invoices out, especially if it's cost reimbursable, you actually have regulatory support for continuing to invoice rather than a TSP up to 6 months post termination. Don't stop invoicing because, well, I should say, let me just, you at least to the termination.
Yes.
And
From
it's
6
like, my point is sometimes these things get terminated mid-month.
Right.
They often do, they more often do. And, that end of month invoice.
You can't close your books because it's on a Wednesday, it gets terminated.
You should invoice up to that termination point as soon as possible.
Right.
And obviously, honestly, if it's a cost reimbursable, you can invoice for costs incurred post notice of termination.
Yes. No, exactly. So, a good best practice here is to keep in touch with the TCO, the termination contracting officer, get those in, get a sense of when it can be settled. The sooner you get it in, the better. The sooner you're invoiced, the better. It's all comes down to timing. I would ignore that 1 year. You have 1 year to get it in. I'd get it in as soon as possible.
Yeah, you
You always amended it too.
well, yeah.
So, but you want to get it in. You definitely want to get it in. I mean, what the DCA is saying is, and I haven't had any clients that actually have had any of these audited yet. I don't know if you have.
No, I haven't. I think that's where speed and generally, generally they're often getting improved quickly. I mean, you'd be surprised, you get it in quick. I think speed, it's got support. It's got support. They're gonna improve it in most cases. Now I understand if you're getting aggressive, there's some nuanced areas where you're gonna have to explain and provide support. That's why revealing and reflecting the underlying thinking and rationale and the entitlement is critical, so they can understand where you're coming from, and that your analysis is based on hard regulations,
Mhm.
and you're entitled to this per the regs. So, important step. Okay, so here's a quick word about FAR Part 12. We talked about FAR 12. We wanted to spend at least a slide exclusively on terminations for contracts, commercial products and services. If you've got the contract clause, now all the FAR Part 52 are contract clauses. So if you've got 212-4, it talks about termination of your commercial, what used to be called a commercial item contracts, now called commercial products and services contract. You're entitled, this is referred most of the litigation case law around this is a two-prong process or two-part. First prong is a percentage of contract price reflecting the percent of work performed to the notice prior to notice of termination. So that's like, look, if you're 75% through, and you build, I don't know, maybe 70%, you're going to be been paid 70%. You're entitled to the 5% difference. It's like you're basically entitled to. That's the total amount you're entitled to. Obviously subtract what you've invoiced and been paid. Plus, this is prong two, reasonable charge the contractor can demonstrate have resulted from termination. Here's the blurry language. Reasonable charges. Are those costs? Are they price? We don't actually, there's been a lot of litigation on that term, charges. Even a commercial item price-based, you can't see my costs type contract. You are permitted to tabulate costs associated with termination. Some of those as part of your FAR 12. that's far apart. Let's see if it's on this slide. If it's not, it's far apart 12403, okay? There's some language there.
Little bullet right there.
Yeah.
At the top.
Yep, at the top there. Oh no, that's 52. So it's far apart 12.
No, second bulletin,
Oh, I see. Okay.
plus reasonable.
Now there's an end note there.
Yeah.
You can see it. Yep. So, a modified price-based formula. So the first price, seconds cost, exempt from the Truthful Cost and Price and Data Act. You don't have, I don't think it's, if your FAR Part 12 termination settlement proposal exceeds $2 million, it doesn't matter. You're in the clear. You don't have to worry about what we just talked about on Truthful Cost and Price Act data. You don't have to adhere to FAR 31 or the cost accounting standards. You don't, you're not entitled, you're not you're not subject to audit. No one can be entitled to audit. No standard settlement language. And then you also have simplified application method, FAR 3013, that's for small dollar stuff.
All right, so we get, it's about, Rose, it's about 30 minutes since the last secret word.
Perfect. The second password is AIR, capital AIR. Again, that's AIR, capital AIR. That's the second of 3 passwords. Make sure you're writing these down and be mindful of capitalizations. All right,
Do
back
we
to
have any
you. I don't see any.
questions?
No, I don't see any currently. That means you're being nice and thorough.
Excellent. Okay. Well, we've beaten up terminations of cost type contracts pretty well today. Right?
Let's beat some more.
But it's very
It
straightforward.
deserves it.
It is very straightforward. You're able to recover all the allowable costs incurred up to the termination date. That's a simple invoice of your regular work, and then, you know, all your termination costs. So, and profit. So that's a key piece right there. It's getting that profit. And I don't know what else we could say about it. It's all the cost. Get the profit, voucher for costs up to 6 months.
Yeah.
Submit your settlement proposal.
Yeah, and there's some uniqueness on cost type contracts with profit calculations. Sometimes various claims have different profit rates on a, or
Yeah,
CPFF for, you have a cost plus fixed fee. You know, that's especially with the CPFFs, you might need some additional
Oh, there is one other thing.
calculations for fee.
Yes, no, there's also one other thing to be mindful of, is your funded value of the contract as you're going through these calculations. And you keep that in mind of what your funded value is, because if you start to exceed the funded value, you're gonna have to go back and get some more funding. Just to keep that in mind.
And what we're seeing too is especially in cost reimbursable, is the first step. Once the notice has been sent out, everyone's starting to get organized. Okay, let's put a project team together. We're going to do this termination settlement proposal. We're going to keep, what's often the first step is the CO will say, tell us what should be de-obligated from the ceiling or the funding. We need to reallocate money. We're getting, you know, maybe the government's agencies getting pressure elsewhere. And so they'll ask you to tell them what amount should be de-obligated, which is essentially lowering the ceiling in effect on the determination amount you can seek. So you don't want to lower that too much or any. In fact, today we counseled a client not to lower it at all, even though the government was telling us, you know, what are you going to do? Take anyway, so
It's something to think, it's
that's
definitely
the-
a strategy to think about.
yeah, hurdle, if you will, kind of an initial concern to be mindful of and to tackle.
Yes. Okay. We on grants and awards.
Okay, so now let's touch on grants and cooperative agreements. These are assistance awards. These are just different beast than a procurement. Assistance awards are governed by the uniform guidance. They are, they don't have profit associated with it. This is where they're in place to further some governmental goal for the greater good of society. And that's what grants and co-ops do. we recommend, and there's no, the uniform guidance does not have the well-developed termination regulatory section that you see in the FAR, especially FAR Part 49. That given that, we think and recommend that a cost reimbursable model be placed on top of a grant or co-op that's in a termination status. And to follow the, obviously there are cost principles with grants and cooperative agreements, and those are specifically in 2 CFR 200 subpart E cost principles. 2 CFR 200 for everyone is essentially synonymous with the uniform guidance. That is the numerical location of the federal code that these grants and cooperative agreements reside. I think they're only about 13 or 14 years old. They're not that old. It came into existence in 2010 or thereabouts. I may be a year or two off, but anyway, so in order to be allowable, we're going to talk a little bit about, now we're stepping into very strict cost compliance rules on the cost reimbursable side. It needs to be a cost incurred in the performance of a grant or co-op agreement needs to be necessary and reasonable for performance. It needs to conform to limitations or exclusions. In other words, it needs to be allowable, no unallowable costs. Same for contracts, but the unallowable rules are in subpart E for the uniform guidance. Otherwise, adhere to allowability requirements and the allowability costs. We recommend using the cost reimbursable contract standard form 1437. It's not a requirement per se, but it provides a little bit of structure that perhaps the awarding official will be familiar with. Maybe they won't, but at least provides a reference point.
So, we've talked about pulling these PSPs together, and we've talked about, how to do it. Goes in it, but doesn't go in it. So some of the best practices with the development of the TSP, there are a few things we've listed up here. I like to point out, not to speculate. If you're gonna put in an accrual or something like that, or an estimate, make sure it's more than just somebody's, sticking their thumb up to the wind.
I should make calculations.
You got to make calculations. It's got to be something substantial
Based on a contract.
Right. And then something else that's probably, and we can talk more about this, but it's getting your rates that you have not settled in the past years, your indirect rates, getting those trued up, building those things out so you can at least get those true up or those indirect rates built out and settled. And then you've got, because that's one settlement there, and then you've got this settlement here. And once you start closing contracts, it's going to get harder and harder to settle the older rates.
Yeah, on the rate note, I mean, the rates, the problem is too, is the rates are just, actual rates are going sky high. They're getting blown out for the destruction of the base, given widespread termination, to get into some geeky rate discussions. So using either last year's approved rates or, we get into some methods, even the ICLE formula for recovering indirect costs that are a bit novel, but we've done that and we think they should be incurred. Again, this is about making yourself whole.
Right, making yourself whole.
And the business, many of these businesses have been turned upside down and are teetering. You've gotten a 50% revenue hit, et cetera. In cases like that, you need to think differently. You can't just, otherwise you're massively under recovering.
Right.
On your indirect costs.
Right.
The other thing I want to point out is I like the reasonableness. And so this is dates back to the prudent person rule. It used to be called the prudent man. It's better named prudent person. This is 120 years old. It's from the early 1900s. Essentially, basically, costs or any kind of consideration incurred by a prudent person in the conduct of competitive business. So it's not a set amount. It's a reasonableness measure or hurdle, and you can impact that reasonableness with the effectiveness of your argument in your narrative and the why and use of hard data as maximum to a maximum extent possible, right?
Yeah, I also, I like to point out, the folks that are in the C-suite or back office or in the G&A pool, you get get those charge numbers set up so they can charge directly to these termination costs, because as you mentioned, the G&A rate's gonna go all wacky. You will recover the time that is spent with the contracts managers who aren't usually direct, or the accountants that aren't usually direct in recovering those costs.
Yep. So we talked about submission time and proposal, that's critical. One thing we have not mentioned, I don't think, avoidance of loss adjustments, and this is a unique rule with fixed price terminations, FAR Part 15, fixed price terminations. So let's say you're performing on a fixed price contract and you've actually performed, at least from a cost management perspective, rather poorly, and you're in a loss position. But the government doesn't know that on a fixed price contract. They're paying you their fixed price. You can't make yourself well by submitting a termination settlement proposal. So the government makes you prove to them on a fixed price that that you're in a profit position. You were managing to profit. If you are not, then there is a proportional decrement to what you recover. It's not that you don't get your money in the TSP, it just gets lowered by basically the loss position you're in at the point of termination. So that's a unique step that's required with fixed price contracts. So, yeah.
So as we mentioned, there's a lot of people involved. That's why we get the charge number set up, because everybody's going to touch this proposal. Okay, and it's important to make sure that folks are aware that this is happening. So if they're being asked to do something, that they're aware.
Yeah, it's multifunctional. It's really, it's a very broad-based group.
And I think we've also hit along, recovering allowable and allocable reasonable costs.
Yeah, let's tie it to 31. Yeah, I mean, this is FAR Part 31. That's where that language comes from. Allowable, allocable, reasonable. We talked about reasonable, talked about allowable. Cost is allocable to a covered contract when it can be assigned or charged contract to cost objective, basic benefits that cost that contract to cost objective, directly or indirectly. Okay, so both of that, and that's that causal and beneficial relationship.
All right, so let's say we don't get a TSP agreement. What's next?
Okay, so, and we'll just get a touch on this. What happens, let's say that you submit the TSP, government comes back, this is trash, we're not going to agree to it. You do negotiations, it doesn't work out. You can, as part of your submission, you are requesting a final decision. I think it's 60 days. You're permitted the CEO has to provide a quote final decision. And if that final decision is a no, well, then it's time to consider suing your government customer. That's going to be, by the way, we're not attorneys here. We're financial people, but this is a pretty simple process.
Trustee,
Exactly. The CDM, the CDA, or Contracts Dispute Act of 1978 governs this process. At this point, you now are assembling a certified claim where your representative officer, the CEO, CFO will certify. There's a lot of weight that goes with that certification and a lot of risk that individual. And you're also seeking some certain amount. If that is rejected, then you are able to appeal that decision to one of the various courts that handle federal disputes and federal claims. Court federal claims is one of those. And then there's others, but basically then it goes to full litigation and you're seeking, there's other cost differences in terms of what you collect. And we help with companies with certified claims all the time.
But then unfortunately, once you submit that certified claim, allowable costs kind of flip around.
Right. Well, yeah, there's differences like interest and some certain, and you're right. So
Something to think about.
yeah, SWOs and REAs.
Okay. So what happens when you get the stop work orders? We talked about earlier. Typically, you'll get the stop work order before you get the termination notice. But once you get that stop work order as mentioned, and more likely that the termination is gonna come right behind it. So once you get the stop work order, yeah, obviously you have to stop working. You have to then start to think about, okay, how am I gonna start reducing my costs going forward? What are ways that I can show the contracting officer, you have to stop work and we're gonna start mitigating future costs. We need to do that. And so you need to start figuring that out. You need to start capturing that as well. When you get that stop work order, you also need to let your subcontractors know, any consultants that are working on it, any partners, or if you're in a JV, that's going to be another story. You have to let the other JV know as well. And so with that, I think those can happen at any time. And a stop work order, once it's stopped, it can be turned back on. So there's a positive there. That's why
It's not being terminated,
it's not being terminated. It's just
at that point.
time to stop. It's almost like getting your ducks in a row there.
And the costs are different. You're standing ready, you're standing by, so there are costs incurred to keep people in line to be ready to restart.
Right, so you have to, you give those folks who are usually direct, you give them some other charge number to charge during that time. They might do some training or things of that nature, or maybe some, I don't want to say cleaning of the floors, but so to speak, cleaning of the floors.
Training of.
Yeah. So as I mentioned, actions post receipt of that stop work order, notify all the subs, start scenario planning. And this is where it gets a little tricky as you start figuring out, okay, what's my cash flow going to be? How many more invoices am I going to get out? What's the impact on the indirect rates? What's my revenue impact? And you're going to start modeling all the various scenarios. If the stop work order, lasts a week, 2 weeks, 3 months, what's the impact there? How am I going to start mitigating those losses? We're going to stop travel, we're going to stop other indirect activities, things of that nature. Again, a follow-on action once it's received, review the contracts and the grants, make sure that everything is well understood and you understand what are the implications. Maintain your records, it's very important. And then as I mentioned, contingency planning, very important there as well.
All right, so we're going to talk real quick on the home stretch here, a little bit about equitable adjustments. And so a request for equitable adjustment is very similar to a termination settlement proposal. It is a proposal, it's a contract administration duty or activity, but it's where rather than a termination, there's been some change to the scope of the work that has increased costs, either it's constructive change or an express change. The government has the right to make changes. On the other hand, an equitable adjustment is the cost impact of the change, and the contractor is entitled to be made whole. That includes cost incurred in performance beyond the scope, associated profit with that effort. Next slide. Just like the TSP, we talked about entitlement, the why. The government's directly responsible for that. You got to make sure that the government is responsible for the delay, the impact, the change. The contractor could not have prevented the additional cost incurrence. Did everything they could. On the other side, just like a TSP we've been talking about, need to provide evidence that costs are reasonable, that they're necessary. The intention is to be made whole. We said that probably too many times, driving that whole. Do not allow for loss due to other contract inefficiencies. In other words, sometimes the contractor's inefficient. There needs to be a deduction for that, an admission that there were inefficiencies in place. Again, increased cost to the contractor is the focus. And there's a bit of a just a few process here. Sometimes there's a site condition problem that was no fault of the contractor. In that case, the government needs to demonstrate that it was different, or some preset mutually agreed to circumstances were not met as a result of the government's failure to stick to its part of the bargain. You must prove that the change or different site conditions or delays could be often just a delay government was going to bring something to the table or something as part of performance didn't happen. And the contractor must show resulting injury or essentially additional costs. Same thing, develop effective project cost documentation procedures for the beginning of the project. Same for TSPs, critical, effective project cost documentation procedures.
Absolutely. All right, wrapping up here. So with this, there's some observations and takeaways that
Yes.
are very important. As I was writing through it, I think one note that I had to we beat up a lot was to communicate, not only internally, but externally.
Yep.
Good with the employees, subs, contracting officers, government auditors, whomever it is. I think it's one thing I'll point out.
Yeah, we didn't talk, with subs, they're gonna submit a termination settlement proposal to you, and then you're gonna, evaluate it and examine it and approve it presumably at some point.
Mhm.
And
Put it
include
in.
that. Yeah, so that's how that works. Listen to the termination notice and follow notice. Often you've seen agencies or departments provide department or agency-wide guidance on terminations. We're seeing that in 2025. Make sure you're watching for that and following that. And, we talked about the importance of continuing to invoice and then also basically include those costs in a TSP if they're not paid. You've got to take every step because the likelihood of you being paid for an invoice, frankly, paid quickly for an invoice is far higher than it is for the TSP.
Yeah.
So get the invoices in, you're gonna get paid quick with in most cases, I mean, as long as they're not, for the wrong periods, you're gonna be paid quick and then worry about the TSP.
Right. Yeah, exactly.
And it's okay to double count there. Because you're gonna deduct it.
You'll deduct, exactly. Accounting practices, set up those charge numbers immediately so you can start capturing that. We've had a couple of clients that decided not to set up charge numbers and it gets a little convoluted and a little difficult going forward because then they had to go back and figure out, oh my, well, I don't know how much time we spent. I said,
Watch the funding limits too.
watch the funding limits. Very good.
Yeah, that's the de-obligation request.
Oh, the last one there, develop the cost workbook before writing the narrative.
Yeah, we've seen that a lot. Or completing the standard form. Do the costs first. Let's figure out, it's all cost collection and coordination first. It's project management, it's teamwork. Everyone, there's a lot of people involved, HR, accounting, legal, manufacturing, quality assurance. Everyone's got to be involved. Anyone who does something that's going to impact the costs incurred, senior people, right?
Right, and you gotta talk to the people who are being terminated too. You gotta have somebody who's it's almost like you wanna have a program manager for each termination proposal because they've gotta touch all these people out there.
Yes. We haven't even talked about severance costs, the Warren Act costs. These are all direct labor costs. Those are all important parts that play into it. What have we not touched on? I think, you can build with basically just with a cost reimbursable, you continue to submit vouchers and then down the road submit it to TSP, down the road a little bit, 6 months. That's what the regs say. I mean, talk to your CO, submit vouchers, work on the TSP. And maybe you can get everything paid for without vouchering.
Okay.
Yeah.
Okay,
How are we doing?
Rose, how are we doing?
Great. With 2 minutes to spare. I'm going to go ahead and put up a couple polls before we log off today. It should be populating for everybody. Okay, perfect. Thank you everyone for joining us today for Government Contract and Award Terminations post DOGE. A big thank you to Rob and Clint for sharing their insights. There is a poll up just asking you to please rate this training as we're always looking to improve. All right, take that down as I have one more. Sorry, I'm not able to push. I'm gonna look one more time, sorry. Let's see, nope, still no questions I don't see here. Perfect, all right. For those of you seeking credit, the final password is AVATAR, capital AVATAR. Again, that's AVATAR. That is a third of 3 passwords. You'll need to log into your account on the PCI website, go to My Certificates and Courses, select today's training, and complete the short survey where you can input those 3 passwords I announced during the session. So just make sure you have them written down as they were shared to get that continuing education credit. Let's see. I think I took that down. Is there anything else you wanted to share on your deck? I think someone raised their
You
hand.
have our email, so please email us if any questions come to you later. We're happy to answer them.
And then Elizabeth, did you have a
Sharon,
question?
thanks for joining.
I did have a question. If we don't have time for it, it's not a problem.
We have time. We have a few minutes.
Absolutely.
Others want to drop off. We're happy to try to answer it.
Okay, you talked about the time period for termination settlement proposals, that the FAR gives a year, but we've been experiencing that when we get the request from contracting officers, they're asking for them in a matter of a week or two. I just was curious about your thoughts on that.
Oh, that's a great question. I mean, let me start that off, because just like the amount is negotiable, so too is the time frame. And my firm belief is that that is generally an unreasonable time frame to put together, a complicated termination settle. So if you're putting together a proposal that's several hundreds of thousands of dollars or more, you need time, and you need to buy time. I'd like to know what their reason for that timeline is. The regs do say 1 year. You obviously want to throw that out.
But that also begs the difference. You can also invoice, just start invoicing it.
Well, you should invoice through termination.
Yeah.
Yeah, invoice through termination, but there's still a lot of other costs.
But it is unreasonable. 1 week it's definitely.
That's, they're trying to squeeze you. I mean, what I've said is go fast, but go big. And the problem is you can't go big without like swag. I mean, you have to do some estimating. I would, under the guise of de-obligation, you could put together a very rough estimate of the total cost without having really done all your homework, and have a nice fudge factor. And there's nothing wrong with submitting that and saying, look, we need more time, and here's what we're working on. It's unreasonable to do that in one week or two. They've terminated you for their convenience. Point to the regulations that back up your arguments.
Great, thanks.